Real estate investment practice problem using Excel. Points explained and analyzed part 1. Get ready because we're raising the stakes with real estate. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we have 3 tabs on down below: example tab, practice tab, blank tab. Let's start off with the example tab, taking a look at it. It in essence being an answer key. We're focusing now on points, the idea of purchasing points if you have the capacity to do so. The concept of purchasing points being fairly straightforward, but it becomes a little bit more complex as to whether or not it would be beneficial to purchase the points and under what circumstances it would be beneficial. Also, comparing points to other loans when points are involved or not involved can get somewhat complex as well. So the idea of points being you can purchase, sometimes it's called paying down the rate. You purchase the points, the rate then is lowered, which could have a positive impact over time on your loan, and it could also reduce the payments, which might make it easier for you to be making the monthly payments. Now, that kind of confuses, however, the comparisons of different loans, and the actual rate that you're paying, if you take into consideration points, can be a little bit confusing as well. Also realize that if you're paying down money up front, you really have 3 options that you're considering, right? You're considering, 1, should I have no points and just keep the loan as what I need in order to pay for the home, given what I've put down? Or 2, you could basically pay down the loan. If you've got the money up front, you could use it to pay down, in essence, the loan. Or 3, you could pay for the points to pay down, in essence, the interest rate. So there's really kind of 3 things that are being involved. Usually the decision is framed in terms of either purchasing the points or not purchasing the points, but you do have that kind of 3rd option where you could be, basically just pay down the loan amount. So you'd have a lower loan amount, in essence, putting more in the deposit. Now, the points will usually result in the most low payment amount, which is why you usually have that dual kind of comparison. Then the question is it relevant to do that? Is it worthwhile to do that or not? And we'll talk more about that in future presentations. Here, we want to just get a better idea of what points are, because it could be a little bit confusing when you think about them in the context of the full loan. So we'll be calculating those here. The practice tab will give you some of this information with some more blue cells that are already pre-formatted so that you can work this practice problem a little bit more easily without having to do much formatting. The blank tab is where we're going to basically do the formatting from scratch, just building this thing from scratch. And here, so we got our information. I'm going to say the home is $200,000. I'm not going to put anything down at this point in this calculation because I just want to keep the loan amount at that $200,000. So in essence, we're just thinking about a $200,000 loan that we need for the purchase. Then we have a 30-year that's going to be fixed. The months then 360, 30 times 12. We're going to start off with the rate at 5%. We're going to assume that 5% is before any points that are going to be taking place. Now, and then we got our calculation on the payment down below, which is going to be our payment calculation we've seen in prior presentations here. So now we want to think about, and I actually updated it a little bit just to pick up that 5% up top. So now let's kind of fix our worksheet and think about, well, what if we had points involved? How can we kind of adjust our worksheet to basically take that into consideration? So first, I'm going to try to put just the points here. I'm going to say points. And usually when you buy a point, that basically means you're going to get a % down on the loan. So in essence, 1 point would be 1% of the 200,000. So if I purchase the point, 200,000 times 0.01 would be 2,000 that you'd be paying in order to get some reduced rate. And the reduced rate might be like 0.225% or something like that. That's what we're going to assume here. So what I'm going to do in my worksheet is I'm going to say, okay, here's the worksheet without points. I'm going to say, let's say I purchase points. Let's say 1 point here that we're going to be purchasing. What's going to be the impact on the rate? So I'm going to call this the rate decrease. So I'm going to say the rate decrease per point. Let's say for every point we purchase, they're going to decrease the rate 0.0025 or 0.25. I'm going to make that a %, number group %ifying it. And I'm going to add 2 decimals. So we're going to assume that 1 point is going to bring the rate down 0.25%. That's 0.0025 decimal 0.25 on the % side of things. So then we're going to say, well, then the point fee, the cost of the point, cost of points. The cost of the points is going to be the 200,000 up top, the loan amount. I shouldn't say the home value. The loan amount times the point. The point means a percent of the loan amount. So to calculate that, to get that 2,000, it would be equal to the loan amount up here times the number of points. But then I got to make that into a decimal. So times 0.01, we should then get to that 2,000 amount. So 2,000 should be there. It's not. Let's try it again. I said times 0.01, times 0.01. There it is. So if I change this to 2, we're going to get 4,003. You usually have like 0 to 3 points that you can purchase and have the option of paying down the rate. It could be some, they could do whatever they want, but that's going to be in 0.25, fairly standard. You want to see what the terms are, but that is common. So then we're going to say, okay, so that's going to be the cost of the points. Now, what's going to be the rate then? The rate after points. If you pay down the rate, then what's the rate after you pay down the points? It's going to be the 5% up here minus the 0.25, whatever. So that's going to be 4.75. Let's do that with a formula. This equals the 5% up top minus the 0.25, that 0.25, but I got to multiply that times the points that are going to be up top, because that's what it's going to be, 1 times the number of points. So I'm going to say, okay, does that give me what I want? Let's make that a percent number group, percentifying it, add a couple decimals. Yeah, we're at the 4.75. If I change this to 2 points now, then we'd at 450, 3 points, we'd be at the 4.25. Let's bring it back down to 1. So there we have it. Now my payment calculation, if I would like to, I'm going to bring it to 0 here. I would like to base this payment not on this 5% up top now, but on this 5% on down below after the points. So I'm going to double click on this payment calculation. We're going to make this rate cell. I'm going to delete that rate cell, and I'm going to pick up the rate here so that we calculate it after the points are impacted. So now we've got our worksheet. I'll make this blue because we made a little adjustment there. So now we have our worksheet set up. So if I add the points, it should then calculate the cost of the points. It should then give us the rate after the points that are going to be applied, and then give us the payment amount, and that should be adjusted as we add points. So that's the first thing we can, and that you could see why we would buy the points, right? So if I paid for 1 point, I'd pay 2,000, and I'd get the rate going to the payment 1,043, which might make it easier for me to make the payments in the future, given the income. 2 points, the payments down to 1,013. 3 points down to 983. The rate at the 4.25. So that's kind of the idea of the points. The problem here, though, one problem is, well, one, is it worthwhile from a total dollar amount to purchase the points? Because I've got to put $6,000 up front in order to lower the payment to that amount. So is that worthwhile? And then 2, well, how do I compare this to other loans where they don't have points, for example, and they're charging me a 5% rate or something like that? How do I do that comparison? So the first one, we can think about, well, what's like the real interest rate? If we think about the real interest rate, or like the effective interest rate, after we consider the fact that we have to pay the $6,000 in this case, if we bought 3 points, then what's going to be the rate that I can use to compare to other loans, in essence, rolling the cost of the points into the loan amount so I get a percent that is comparable. So in other words, I'm going to call this the effective rate. This is not going to be a rate that we're going to use for the calculation. It's just going to say I want to roll that cost of the $6,000 into basically the percentage, in essence, so that I can have a rate that I can compare to other loans. Otherwise, I have to compare the 5% other loan times versus the 4.25 and the cost of the 6,000 points that are there. And that's difficult to compare those two things because they're not apples to apples, same thing. So we'll use our rate calculation to do this. We're going to say this equals the rate brackets. The number of periods is going to be that 360, comma. The payment needs to be negative. So I'm going to say negative of the payment that we calculated down below, the 983.88, comma. Now the present value, if I choose the loan amount, which is the 200,000, that's going to get us to that 4.25. In other words, let's do that first. If I bracket this thing up, that's going to give us the monthly amount, and then multiply it times 12 to get the yearly amount, making that a percent number group, percentifying it, adding a couple decimals. There's the 4.25. Now what I'm going to do, the little twist here, I'm going to double click on this last one. I'm going to take the 200,000 because minus the 6,000, the 200,000 minus the 6,000, and that's going to give us then the 4.51. So really, if we look at the rate and we try to roll in the cost of this 6,000, we're really having the 4.51 rate, and this is a rate that we can then use to kind of compare to other loans possibly that have different kind of structures. We're trying to roll everything into 1%. Now the problem with this number is that when it calculates out over the full 30 years. And if you're not going to have the home for 30 years, even though you took out a 30-year loan, you plan on selling it within 10 years or something like that, then that kind of skews the calculation a little bit in terms of whether it's worthwhile to be purchasing the points in general, and it kind of makes the comparisons a little bit difficult when you're comparing different loan amounts as well in that instance too. So to get a concept of that, then let's kind of think about what this calculation means a little bit more in depth. So what I'm going to do here is I'm going to bring this back to 0, and I'm going to try to compare something without any points to something with points. And what I'd like to do is a side-by-side comparison. So I'm going to copy this whole thing and paste it over here in column K, have one with points and one without points. So to do this, I'm going to put my cursor on column A, drag on over to column I, let go. I'm going to right-click on that selected area, and we're just going to copy the entire thing, and I'm going to put it on over here in column K. So we got this side-by-side, and I'm just going to paste that normal, just paste it on down. There's a couple things. We got to make sure that the amortization table has been populated properly, because any absolute references are going to be drawn from the prior data set. So for example, the payment here, I'm just going to adjust this. That's pulling from something in column B. We need it to be pulling from here because it's absolute with the dollar signs. So I'm going to say that payment needs to be pulling, it's the right amount, but it needs to be pulling from this data right there, that number. And then I need to make it absolute, F4 on the keyboard, dollar sign before the L and 14. And then if I just simply double click on the fill handle, it'll populate all the way down. The same is true with the interest. This absolute reference right there is pulling from the prior data set. I'm going to delete it. We're going to be pulling it from that 5% right there, make it absolute, F4, dollar sign before the B, or before the L and the 12. And then we'll put our cursor back on it, double click on the fill handle, bring that down. Now the check on it is then to change these points. If I change this to like 3, and then scroll down, this amortization table should get to 0 all the way at the bottom. That's your check figure. And you get to 0 all the way down there. It looks like it's calculating the way it's supposed to be. So now I can have this side-by-side thing and see the amortization table, this one including the points, the prior table not having any points, and we could do this basically side-by-side comparison. So now let's think about basically, what the points kind of mean. So let's try to do a calculation like this, and this is like a time value of money calculation, just to give us an idea of what it means for these points to take place, or what the impact will be. So I'm going to say this is with no points. We're going to start off with no points, and then I'm going to look at the cash flow. So we're just going to look at the cash flow, and we're going to take the present value of the cash flow. So I'm going to then highlight these, go to the Home tab, Font Group, and let's make this black and white. And then I'll center this. I'm going to bring this from 0, 1, 2. Select those cells, bring that all the way down to 360. 360, as we've seen in the past. Center that, Home tab, alignment, and center. Then I'm going to say the normal loan, I'm going to say is equal to the cash of the 200,000 over here. That 200,000 in essence is what we received. We didn't get it in cash. We got it and paid for the home with it, right? And then we had to make these payments, which I'm going to put negative for the outflows, which are going to be equal to the payments that we made I'm going to pull them from the amortization table, which is going to be that 1074, and enter. So there's our payments. We're going to copy that all the way down by simply double clicking on the fill handle. That'll take that same payment all the way down. And then what I'm going to do is I'm going to present value this. Now the present value, I'm just going to take the present value of 1 and just copy it all the way down. And let me see if I can explain what that is. I'll start down here. So what we have here is our cash flow. We had a cash inflow from this of the 200,000. Now it's not actually a cash inflow that came to us, but you can think about it as going that way, right? We got a loan for 200,000. They gave us the money, you can imagine, and then we gave it to the seller of the home for the home. And then we're going to have 360 outflows, which is our payments from a cash standpoint. So now I'm going to do our present value calculation to see what the value of those outflows are. So we're going to say negative for our formula, present value, shift 9. We're going to pick up the rate. I'm going to go left arrow all the way to the left, looking for that 5%. 5%, the one down here, F4 on the keyboard, making it absolute. Now that's going to be the yearly rate. We need a monthly rate, so I'm going to divide that by 12, comma. Number of periods I'm going to pick up over here. That's 1 represents 1 month. I do want that to copy down, therefore no absolute reference, comma. We're not looking at a payment because the payment would then be an annuity, 2 commas, because we want the future value, which would be that 1,074. If I hit enter, we now discounted the 1,074 back 1 period or 1 month by 5% divided by 12 for the monthly rate to get that 1,069. Let's do it one more time and then we'll copy it down. Negative present value, shift 9, rate all the way to the left. We're picking up then that 5%. F4 on the keyboard, making it absolute, dividing it by 12 to get the monthly rate, comma, number of periods is going to be that 2, representing 2 months, comma, no payment, because that would be an annuity, 2 commas. We want the future value, that 1,074. If we discount that 1,074 back, 2 periods, 5% yearly rate, we would get 1,065. All right, let's copy that all the way down. Double clicking on this cell, copying it all the way down. And there we have it. And then I'll scroll down to the bottom. And we're going to say this is going to be the total then. Total, summing this up equals the SUM. And then I'm going to just page up all the way up to the summit of the column to summit. And there we go. We got the 180. And then if I sum this one up, equals the sum. Then we get the 200. Hold on a sec. I should have done the present value one more time up here. I didn't start there because it comes out to the same number, which would be 200,000. So the 200,000 should be up top. Then if you sum it up, you come out to 0, meaning that's because that's the rate, the 5%. So it plays out the present value of each period, if I take it back, would be 0 at the end. You can also calculate that using the IRR calculation. That's called the internal rate of return. And this will become relevant. I'm doing this first step, so the next one will become relevant here. So now we're going to say if I did the IRR equals the IRR of this whole column, not including the total, all the way up, then making that a percent, number group percent, couple decimals, we got to multiply times 12. That would be the monthly percent, and then we'll times 12 to get the yearly percent, 5%. Okay, so we just kind of proved that 5% kind of what it's doing if you discount every payment and so on with the 5%. Now, funny thing happens with the points. Let's consider the points situation. Say, okay, well, what about like with the points then? If I copy this on over and say, now we're going to do the same thing with the points, 0, 1, 2. Let's copy this down to 360. Following this down to 360 again, right there, centering it, alignment and center. And then we've got the cash outflow. The outflow really this time, we got the 200,000 that we used to pay for the home, but minus we had to pay another 6,000. So what really happened at that starting point is we got 200,000. We didn't get it personally. We got the loan that we used to pay for the home. And then we paid 6,000 in order to pay down the rate, as they say. And therefore, what we paid up front, is a net, really, of 194,000. That's kind of what we got up front. We got the loan that we needed to pay off the home, and then we had to pay down the points with that 6. So we got the inflow of the 200 minus the payment of the points. So if we consider that, then we look at the outflows, negative outflows, which is going to be that 984, and copy that down, double clicking on the fill handle. Then we could do our same present value calculation here. Negative present value, shift 9, rate. Now we're going to be picking up the rate that they gave us, which is this 4.25 after we had paid down the 5% and paid that 6,000. Notice the difference between this and the amortization table. The amortization table is still using that 200,000 loan amount. But we paid down the 6,000. So really, if you're looking at the present value calculation, that's kind of what the difference is here. So now we're going to be taking this amount. So hold on a second. We got the rate at the 4.25. Let's make that absolute, F4 on the keyboard, and then divide it by 12. Divided by 12 for the monthly rate, comma. Number of periods is going to be this 1 again. For 1 month, comma, because it's not an annuity, present value of 1, that 984, and enter. So if we discount the 984 back by that 4.25, I believe, divided by 12 for the monthly rate for 1 month, we get 980. Let's do it one more time. Negative present value, shift 9, rate is going to be the rate they gave us over here, which is going to be the 425, F4 on the keyboard, making it absolute, dividing by 12 to make it the monthly rate, comma, number of periods now 2, representing 2 months, comma, because it's not an annuity, future value, 984, and enter. And then let's copy that down, double clicking, and let's copy that up as well, bring that up 1 item so that we pull in that same 194. Scrolling it down, let's sum this up and see we get a little bit more complicated result. Equals the sum, the total cash flow, then is going to be that 160, 197. So we have a lesser cash flow, which is good, over the 360. If we take the present value calculation, sum of these items up top, we don't get to 0, we get to that 6,000, right? That's kind of the problem. If I was to calculate the IRR, the internal rate of return, the rate at which these series of payments would be 0, that's what the IRR is, and we'll prove that in a second. IRR, and then I take the sum of these items. That's going to give us. Let's add some percent. That's the monthly amount. Double clicking on it, multiplying times 12 to get the yearly amount. So there's that 4.51. So there's that same 4.51 that we calculated up top here, right? So we calculated, hold on a second, up top, there it is, that 4.51 effective rate. So that's kind of where the effective rate is coming from conceptually, just to get one more grasp on it, what that IRR means, because it's important to note that that IRR is being calculated, that internal rate of return is being calculated over the whole life of the loan. So if you took the whole life of the loan, then it looks like you're going to be better off because your total cash outflow over 360 years would be less, but you also need to consider the time value of money, but then your actual percentage rate would be less. It's not the 4.25 that you pay down to. It's over the 30 years, that 4.51, but you might not be holding on to the loan for 360 periods, 30 years. Even though you took out the loan for 360, you might sell it earlier. So you got this question of, well, what happens like in the middle here? Because that kind of works out over the whole life of the thing. And there's a shortcut way to think about that in a more complex way. So one more idea on this, just to get an idea of what that IRR means. If I look at this points cash flow, and I'm going to call this at the 4.51, I'm going to put the rate up top here so that we could see it, and this is going to be 4.51. I'm going to pull the rate from up top, and then I'll make this black and white. Let's do the black and white, and then wrap it here. And let's just do this one more time. One more time. Last thing. Here we go. So I'm going to say this is going to be then the same starting point, that 194, and then I'm going to copy this down, the same items, and just double click that all the way down. And now I'm going to say, what if I did this cash flow and discounted it back at the IRR rate? It won't let me double click that down. All right, I'm just going to drag it down if that's how it's going to be. If that's how it's going to be, that's okay. We'll drag it down. So now I'm just going to calculate it with this 4.51 instead of the 4.25, and we should get back to basically 0 at the end of this. So let me show you the negative present value, shift 9, rate. I'm going to be picking up that 4.51, the IRR rate, and then I'm going to say F4 on the keyboard, making it absolute, divide by 12 to give us the monthly rate, comma, number of periods. I'm going to pick up the 1 over here on the points side. That's 1 month out, comma, comma, to get to the future value, picking up that 984 and enter. So that discounts back to 980. Let's see if we could double click on that one. Pulls it down. Let's pull it up one as well. And then if we scroll all the way down and do our summing, equals the SUM. We got the same total here, but if I copy that across, we should get to, and it's not quite 0 because really this is rounded. This is really 4.508. So if I want to make that 0, let's do it one more time. I could say this equals this amount, and there we have it. And that should, and so the actual rate 4.508 should bring it down to 0. So that hopefully that just gives us a better idea of what this means, this IRR means, and that rate is a rate that you can compare then to other loans, trying to wrap everything up into that one rate, and you can use that as a comparison. But again, it plays out, you could see, over the whole life of the loan, which is 360 payments. So if you're thinking about what's going to happen after 10 years, even though you took out a 30-year loan, that adds to another complication. So we got a couple questions then going forward, and the questions are going to be, well, is it worthwhile to take out, to pay down the rate? Well, if you keep, the general answer is, well, yeah, if you keep the loan for a long period of time, it's more likely to be a beneficial thing. You can see the total payments are going to be lower possibly here, and you have the lower rate over the entire item. But if you don't have it the entire time, then it might not be worthwhile, or it might not play out. And then the question is, well, how long is that time frame? What is the break even? We can calculate the break even on a short, kind of easy way, and then think about it in a little bit more depth as well, which we'll do here. And you can then also think about, well, what about the middle range, which is to say there's a third choice, which is to say I could pay down the loan by the $6,000 amount instead of paying down the points. Where does that fall in this decision-making process? So we'll think about a couple of those in future presentations. Also, we'll think about, what if I want to analyze this not by 360 payments, but by 30 yearly amounts using the pivot tables, which might make it a little bit easier and give you some approximations. Let's go ahead and format this first. I'm going to do our formatting as we've done in the past, making this blue and selecting these items. Font group, let's put some brackets around it, bracketize it, make it blue like that. Let's do this one too, same stuff. We'll put brackets around it and make it blue. And then we can do some underlining maybe on like these. Underline and underline and underline, and then sum this up. Could sum, or make this blue. Make this blue. By the way, if you did the IRR for this calculation, equals the IRR for this series of numbers, then we should get back. We go to the home tab, number percent, and I got to multiply it times 12. Times 12, we get that 4.51. Let's do that, or in other words, 4.508, right? We get the IRR here. So that looks good. So there's our formatting there. So probably a little bit more in depth than maybe you want to know about the points. But again, they get a little complex. So we'll take a look at them in a few more angles in future presentations. Because if you work in this area and you can explain these point things more in depth, just the ability to do so, I think, will probably allow you to impress a fair amount of people and show them that you know what you're talking about, right?